All right, so you can prepare all you want, you can assimilate news all you want, but the other part of this is then putting it into action. This is the game planning, the how do you manage the day in terms of decisions you make based on what exactly is going on. I'm going to give a few different examples here, walk you through a few different situations that form part of your game plan. Now, game planning is something that grows over time, but there are certain key things that you need to consider. Now, we covered a bit of this in risk management, but what I'm going to do is cover some of the other risks that are not necessarily risk management as such in terms of financial risk management, but the way that you go about things have naturally their own risks. And some of the things that form into game planning is the management of those aspects that are not quite so quantifiable, but are very much still there. So what we're going to do is walk through approaches to different days. The other aspect of game planning is understanding where your edge is on a trade. And that's a crucial thing. That your edge is not a setup, understanding profile. Your edge comes from your understanding of what is going on and how you're going to use the current situation to execute a trade. That's where you gain a lot of edge. So we're going to look at different ways that edge comes about, particularly from an execution perspective. And I'll use an example of one of our top traders used to describe edge and the way to understand it. Excuse me, let's go on then. Right, first bit of structuring any part of your day comes down to framing risk. So this is looking much more about the whole idea of taking on more risk on higher value trades. Now, we talked about how to assess the value of trades, the expected value, the function of risk and reward, and how your stop and your target are independent of one another. That essentially is how you frame your risk. That by having those clear metrics, that clear stop, effective cost of trade, that clear target, what you're going to get out of the trade, by having those things down very clearly, then you frame your risk. If you frame your risk and the trade says to you, this is a very, very good trade, this is becoming asymmetric, you need to take that trade on. And by approaching trading from this perspective, from looking at a trade and asking yourself, right, what's my risk on this trade? Is this a good trade to be taken? Does this make sense? Then what that does is that gets rid of the question of, is this the right time of day to take the trade on? I know a lot of people like to, what they call, build into the day. So they'll try and make a bit of money on their first trade and then build up and up and up. Now, what you never know in trading is when your best opportunity is going to come. And so by approaching a trade from the perspective of frame your risk on that trade, understand what you're going to get out of the trade, what the hurdles are to the trade, which I'll come to in a moment, and what the price is that you're paying for that trade. By doing it like that, you can then make a judgment as to whether this is worth taking. You don't know whether this is going to be the best opportunity of the day. But if you are presented with a very good opportunity, particularly one that you could say, well, compared to other opportunities that I've looked at in the past, this is one of the best that I've seen, then it doesn't matter whether that's the first trade of the day. It doesn't matter whether that's 1 minute from the open or 1 minute from the close. That's the trade to take. And by having a look at a trade in this way and having an objective view of it, you can do that. Otherwise, you can end up in a situation where you miss the best trades of the day and then try and make money on the ones that are just not quite so good. And you look back and think, I should have made my money there. The phrase that I've often used, and you may well have heard me use this already, is that you shouldn't sell a current opportunity for a future possibility. What I mean by that is if you're presented with an opportunity now, if you don't take it, you've effectively sold that. You have foregone that potential payout for something that you don't even know is going to happen. It's not even like you can say, oh, well, I won't take that because I'm going to do this. You may not even be able to define what that is. So never sell an opportunity you have now for a future possibility, because that possibility may never come. I guess it's a trading version of the grass is always greener, but you have to eat what you've currently got. So think about it in that respect. What it also does in framing your risk like this is it gives a positive psychological effect after taking a trade on. One of the things that is not quantifiable from a risk management perspective is the psychological impact of taking a trade and not extracting out of it what you want, often because you don't have a target as to what you're trying to extract. So you're always then dogged by what more could it have been? Or the psychological impact of not taking a trade and wishing that you had taken it. Because it's always good, easy to look at a trade afterwards and go, that's what I was going to do and look what's happened. Well, if you frame your risk and you have a situation where you have to take the trade, then there's no reason not to take it and you won't fall into this trap. Equally, you look at a trade and it doesn't ever present itself, well, it doesn't happen. You've heard the phrase before, I'm sure, from me, don't moan about missing trades that you never intended to catch. Trains, even, that you never intended to catch. You can't be frustrated about it, but if the train's there and that's the right train to catch, get on it. Don't then worry or don't then complain when you don't get on it. It goes and you go, I wish I'd got on that train. Do it when the opportunity comes. The other things that you have to think about on trades are what I call hurdles. Now, this is the aspect of a trade, and it's generally more common with a passive trade. But these are the things that when you're in a trade, you need to happen for you to have conviction that the trade is going to work. So the conditionals of a trade. There will be some situations where you take a trade on, and until it gets beyond a certain point, there is no way of knowing whether you're actually right or wrong on a trade. And this is particularly pertinent with trades when we look back to the sort of expected value idea, particularly pertinent with trades that you're getting into with not necessarily a high probability of win, but a relatively high payout. Where people make mistakes is they get into a trade with the expectation that this is going to go, and they assume that they are going to get on side and keep on going. Now, typically with most trades, there is going to be a minimum hurdle to get over before that trade actually does what it's going to do. And that's what creates a lot of frustration. Give a very, very brief little drawing of this. You have a situation like this where you'll buy with the expectation of getting out up here. Now, the market may well then do something like this in a small range. Probably not that crisply, but it will do something along those lines. Now, the mistake that people make here is when it doesn't go straight away there, they then get out of the trade on the hope that maybe they can get in again at a lower price, which they never get. So again, this is another example of giving up a current opportunity for a future possibility. If you get out here and hope that you can buy it back, whoops, not there, back down on the level here, and it never comes back, well, you've just guaranteed yourself a small winner and no chance of the winner that you really should have got. So having that hurdle in mind gives you the ability to say, right, if I bought it here, and I know where my stop is here, I can say, well, until we get past this hurdle, I can't exit the trade. I am not right or wrong at this point. So exiting the trade, all you're doing by exiting the trade is you're guaranteeing that you are not going to get this profit, despite the fact that you are also in no way proven wrong on a trade. So having those hurdles, it's not something that should be seen as a difficulty or an impediment to your trade. It should be looked at and seen as, right, this is a minimum that I need to see. As soon as we're over here, I can now be confident on this trade. So look at them as your kind of barometer of conviction, that as soon as it goes, you can then say, right, that's it. Now I'm in this trade. And now it's going to work. This also relates to what I call price paid for confirmation. Now, the obvious solution to this is to say, okay, well, maybe I don't get in and worry about a hurdle, I'll just get in when the move's on its way. Now, the difficulty with that, of course, is that you are paying a price for this. And the price comes in two aspects. One, you're paying a price in a larger stop. And I know we could argue the point that maybe your stop could now go here, but you're paying the price in terms of a stop. You're also paying the price in terms of a trade that you were quite happy with down here, and excuse all the drawings, you're now actually foregoing this much to get in, and you're minimizing your payout. Think back to the exponential change in risk reward, you're rolling down that curve effectively. So you're losing out, but that's the price you pay, because what you're trying to pay for there is certainty that the trade is going to work. Now, when we do a bit on psychology in the final week, you'll see how that's not necessarily a bad thing. And that's down to your own personality of, would you prefer to pay effectively a high price in terms of the smaller upside and potentially equal, or even if it is minimized, downside, for greater certainty it's going to work? Or are you happy to look for the higher payout and accept that your probability of it working is that little bit lower? Now, these are things that it's not definitive as to which one you should do. This is something that you yourself have to work out, well, what would you prefer? The reason that I would put myself in the category of being a more short-term breakout trader is that I want the certainty element. I want the percentages very much in my favor, and I'm willing to forego the bigger payout for the percentages in my favor. That's my preference. That's my personality that wants and needs that element of certainty and immediacy. Other people are quite happy to forgo that, and they are more enticed by the size of the payout. Horses for courses, different ways to do things. There's not a right or a wrong way, but you have to be aware of these two aspects. Are you somebody who is happy to sit there, acknowledge your hurdle, and wait for the fight through it? Or are you somebody who would prefer to pay an increasing price for confirmation? The more confirmation you need on a trade, the more inputs that have to tick the right boxes, the higher the price you're effectively paying for that, because you need more information, which implies the market is going to be getting closer and closer and closer to your target. Therefore, the price you are paying is high. Because think about it this way. The price you are paying for the confirmation is every tick that has gone past before you enter. If you have to wait till up here to enter, yes, it doesn't necessarily have to be a loss, but you have missed all of these ticks to get in. So that's the price you pay for confirmation. Like I say, there's not a definitive, this is the right price to pay. You have to work that bit out, and that's part of your game planning, of asking yourself, am I willing to pay this price to be in a trade, to get in at this point in time? Or have I now got so much information that in fact, it's not really going to help me out? The other thing that damages people's trading, and again, needs to come into the way that you think about and plan a trade, is what I call the cost of poor execution. Now, execution can become poor by the nature of what happens. So when I say poor, I don't mean it in the strict sense of that was just a bad idea. Because if you can execute a trade, look at it and go, do you know what, that was straight up a bad idea, get out of the trade. There's no reason to be kind of hanging around on that trade and thinking about doing it a different way, get out of the trade. But if it is a case that you have taken a trade on with good solid reasoning and it has not worked, then you have to then weigh up, well, if this doesn't work now, what is the cost to me of doing that? And how am I going to mitigate that? The classic example of this is where somebody will buy on a breakout, the break doesn't come, get out, try again, get out, try again, get out, try it again, get out. The poor execution is in the timing of the breakout. Now, that doesn't have to be poor if you're willing to say, well, if I'm in a small range, and I'll give you a prime example of this in just a moment. If I'm in a small range, well, yes, the execution could be better, but in fact, the poor execution would be getting out of this without ever being shown I'm wrong. And so you're actually having to think, well, I'll go to the bottom of the range to give up. What you're doing there, again, you're playing with the percentages. You're giving yourself the chance to go, okay, I will take a bigger loss if I have to, but I may not have to take that. Whereas if you take the small loss, you take it, you might have to take it again and again, you've guaranteed the loss. So from an equity perspective, realized equity has gone down, which is then recovered. Whereas if you accept that you may take a big loss, but possibly not, then you end up with equity that goes like that. And every so often, you will take the big loss. Again, this is a personal thing. Are you willing to accept a bigger drawdown occasionally, so a bit more of a slap in the face, but for a more consistent, bigger, or more consistent payout, or a higher rate of payout? Or are you willing to take little cuts and then the recovery? The problem with that, of course, is if the recovery doesn't happen, then you've already got burnt slightly, and then you take the bigger loss as well. So there are things to consider, and I'll try and illustrate these with a few different examples of situations that you need to bear these bits in mind. But these are the kind of things that form part of your actual planning out of your day, and what should be going into the thought about how exactly you're entering a trade. Right then, targets first. Talked about framing risk, and I've used this example earlier on in the course, I believe. This is an example of asking yourself, well, what exactly are you playing for, and how does that influence the trade that you take on? Now, I remember this trade very well because I remember talking to somebody about it. The trade's relatively obvious, that what you have here is a high, that becomes support, so resistance, support, support, false break of highs, now the potential for a move lower. The trader I was talking to was like, right, I'm selling it, it's going down. And my question was, well, what exactly is your target? And his response was, well, it's going to go down, so who knows, we'll hold on to it. And that's fine as long as you're willing to accept the market coming back. Whereas if you look at this from the perspective of there's likely to be some people giving up here, and that's the first area of support, that can be a target as well. That's your quick, panicky move. When you get that, that's the one that you can enter and exit nice and quick. Now, if you're playing the break of 56, this is it on a 1 minute chart compared to this on an hourly, then that break comes nice and fast, straight to the level, and then back up we go. Now, there's nothing wrong with that and playing for the bigger move, as long as you're willing to accept that this can come all the way back up, and realistically, your stop's probably going to have to be somewhere up here, around 61. So it's about the awareness of and planning out of how you're going to take this trade on. If you're looking for the big move, accept this going down there, 60, 70, if 80 ticks on side, and coming back and stopping you out for a 50 tick loser. Or if you're playing for the short one, get in, get out, and accept that this may well have gone straight down and you have to step away. Let the train go, if you will. You got what you wanted and get out of that trade. So having targets is so important to the management of a trade and what you get out of it. This is the example of the cost of a poor entry. What you have here then is a situation where we're looking for a continuation trade. This has been the morning trade up here. This is on an hourly, so it gives you the kind of context of what we've been seeing. It's a reasonably strong market. This is Euro stocks. Market trades higher in the morning, backs off, and then we get a little bump up to just below the highs of the day. So at this point here, this little red range is coming in at around about 25 to 21, so just there. So that's the little range that you're trading in. So the objective here, break of range, break the high at 33 up to the previous level at 41. That's the play. Now, where you can have a situation where your poor entry costs you is if you misinterpret the breakout, say here or here. And what you end up doing is you take the small loss. Oh, it didn't work, get out, bang, bang, 2 free tick loser. Now, that's fine, but you've now inched down your equity a little bit, you've lost a little bit of money, and again, and this impacts twofold. One, you've got to make sure you're on the breakout now to recoup it, and also your confidence of the breakout is diminished. One way of dealing with this is to say, right, the real cost of this entry, if this doesn't work, now don't get me wrong, if that works, you're probably not calling that poor entry. So it's conditional on what happens. But if it does start to back off and you go, that wasn't really a great entry, if you have your stop down below the range, you don't get stopped out, meaning that you don't have that psychological slap in the face. You also don't lose any money prior to the breakout, meaning that now your payout is all yours and is not recouping any kind of previous losses. I think the worst mistake people make in this situation is they buy it, get out for a small loss, then try and buy it lower, don't manage that, buy it again, get out for a small loss, try and buy it lower, and then try and buy it again, at which point they're feeling like they've missed out here, not confident it's going to go, and also are more focused on recouping losses. If this is the way that you're going to do it and try and buy lower down, you're better off to, let's say you bought 2 lots here, you're better off to try and add 2 down here on the view that if they don't break, you'll exit those 2, which effectively means you scratched these and got these, and then you're on for the break. That way, it doesn't cost you, but also it alleviates the risk of you missing the trade completely. Because if you don't get these 2 down here, well, that's just told you something. You're not wrong, because if you're willing to buy down there, you can't be willing to sell before there. And so that's how you kind of deal with that, mentally dealing with that, what I call cost of poor execution. Right then. The other aspect is time risk. Time risk is a really important concept. That the longer you spend in a trade, the more things that can change. I'll illustrate this with a kind of theoretical example on the next slide. The longer you're in a trade, the more things can change. So this kind of brings in an element of speculation versus confirmation. that a trade that requires more things to work, hurdles along the way, is also not only open to the fact that those hurdles must break, but it's open to the fact that the longer you're in the trade, the more things can come along that would adjust that. Now, don't use that as a reason to fear being in a trade for a long period of time, because the information incoming that can make something happen could and does over time come just as often for you as it does against you. So being in a trade for a long period of time isn't necessarily a risk of it going wrong. The risk is that the idea you initially had has now lost its reasoning effectively. And so the point here is that trades are time sensitive in some circumstances, that they need to get on with it. And in other circumstances, they don't. Take, for example, this situation, what I would call speculative trade here. If you're selling on the pullback to the single prints, it's a bit similar to the expected value trade. So this is more the mindset part of this type of trade. This does not have a great deal of time sensitivity. You know where the risk is, but for all you know, it could do this for much of the rest of the day. Now, over time, then the sensitivity builds. The longer and longer and longer that we sit in this range going sideways, the less and less likely a breakout is to come, because this would imply that the market is getting very balanced here, and that may well be it for the day. So there is a time sensitivity, but it's quite long. Whereas when you're looking for the confirmation trade, so think you're paying a slightly higher price for this, of course, that you've missed these ticks here, and you're playing the break. This needs to go, and it needs to go quickly. Because the longer it takes to confirm the break of this low, i.e. down here, and then go shooting down here, the longer it takes to do that, the more people in a similar situation to yourself, typically the more short-term, reactive type traders, the more and more of them that will be looking at this thinking, I don't really want to still be in this trade. So this does have time sensitivity. This needs to get on with it, because if it doesn't, you start to increase the number of people who are willing to say, maybe it's not going to happen, and give the trade up. So make sure you're always thinking about the time sensitivity of a trade. The sequence often in how you've got to where you've got to, because the sequence of action influences the time sensitivity. Let's go and have a little look at a theoretical example. This would be an example of before or at the beginning of the day, you could look at your market and say, okay, I know what I've got here. I've got a delayed access trade. The play is break this level, we're going up here. Nice, got that nailed on. You know exactly what you're looking for. Brilliant. Now, the sequence of movement matters. The way the market moves is going to tell you whether this is likely to break or not, and also whether it needs to get on with it or not. It adjusts and it changes the way you're going to take this trade on. So take, for example, this first one. This one is a time-sensitive trade. We open, trade up, create flag, and go for the break, reach the target. Now, there's a couple of things that you're going to need to consider here. One, the distance from which we have reached this level. Now, the further that you have come in a straight line, so the nature of the move and the distance you've come makes the break harder. I talked about this concept before, the concept of running a marathon and then being asked to run 100 meters. That's not going to be an easy feat. So as long as you're not coming from a distance away that is unlikely to produce a continuation move, you could use an ATR to roughly judge that. As long as you're not coming from that distance away, then it's got the scope to go. You've got to ask yourself, well, does the market need to prove its ability to go? And in this case, the nature of the move to get there suggests not. This is clearly a directional move. So the flag breaks, we don't need any more information. The assumption can very clearly be flag breaks, break the level, reach the target, because of the way the market is currently moving. The risk you have here is a time sensitivity. This needs to go quickly, because if it doesn't, it starts to then look like a market that may be struggling to break the level and may well actually be another attempt at the level that is just going to fall away. So time matters in this situation. Equally, as time goes by, this will affect the way the move is taken on, the sequence of the opportunity. So let's take same example, but instead of going straight line to the level, so instead of the opportunity coming perhaps early on in the day, rather than, and this leans to the point that I was making, that if the opportunity is strong now, take it. Because the longer the day goes by, you may still get the opportunity, but because of the way the day is traded, it probably actually diminishes the quality of this opportunity. Why? Because the market has shown that it's very happy to trade here. So this now shifts the sequencing of the trade, and it shifts the time sensitivity of the move and what I would call the proof of the move. So if we get the breakout now, yes, absolutely, you could break the level and we could go for the target. But how you take the trade on is going to differ. This to me is a less time sensitive trade. More what is important is the sequence of action to prove that this can do the move. What I mean by that is if you have a market that is very happy to trade in a range down here and then breaks out, there's going to be a lot more people looking at this thinking, well, it was happy here, back down it goes, false break. So you have a less clear directional bias. Here, most people are going to be looking for the same thing because they're already looking to buy and they've proven that already. Whereas here, much more balanced in view. So this is now a trade that is less time sensitive, and in fact, more time is better. If it can spend some time above the level, then that is proof that it is willing to trade above the level. Now you have a situation where it can continue on. But without that almost necessity for time, this is unlikely to be a move that is going to run, simply because there's too many people very, very happy down here. So make sure you're thinking about that time sensitivity. It doesn't mean get into a trade and say, right, 5 minutes, it must happen. If it doesn't, I'm out of here. But understand what does need to happen. Should this be something that happens quickly? Does it need to show you very fast that it's willing to go? Or is it more a case, as in the second example, where actually time is your friend here? More time proves a willingness to trade here. More time then allows people to become comfortable trading up here and willing to play the move onwards. So sequence and time really, really matter in the way that you take on a trade. I have an example of the S&P. Now, we can see what happens here. We have a very, very strong breakout type move. Great. But the sequence matters before you take a trade on. So this is slightly different to the theoretical one I just presented. The sequence here is what needs to happen before the breakout can come. And when you look at the profile, what you've got, if I move that across slightly, is a rather broken profile, roughly a cave. So in order for this market to move away from here, it needs to find acceptance. What this helps you with in your game planning is say to yourself, well, I don't need to be getting involved too early on in the day because chances are this is not going to be a market that gives me a great deal of clarity of direction. Therefore, I can wait. If I'm going to play a breakout, I need certain things to happen first. I need time to build volume, build time in here, fill the cave. Now, once that has happened, that prominent VPOC becomes a very clean ledge to break. And now you can expect on a break, a continuation move. Equally, had this broken early, you would be less confident in it and you'd want proof. If this had broken early, I wouldn't be looking to get in on the break, and the break comes on the highs from the previous day at 90. I wouldn't be looking to get in on the break. Instead, I'd be waiting for a pullback, waiting for a continuation to play onwards. And if you look at the way that this actually plays out, and we extend profile across this area, you can see then that the market starts to fill this zone out. So in doing so, we start to fill this first part of the cave out. That's doing a good job. You're getting ready to a point where you can believe the move. And onwards we go and continue to fill this out. We continue to build the volume. Now that the volume has been built, the cave is clearly filled, and that's of course subjective, but you can say that very much we have put a fair bit of volume in the area where we lacked it. Now you can look for the move, and it comes. And if you look, very notably, the volume is extremely low there. It doesn't spend time there. It doesn't come back once it's broken. And that's a factor, again, of understanding sequence of what's happening rather than just simply seeing an opportunity as it's a break of a level, off we go to the upside. The sequence matters so much in this situation.
Part of sequencing is understanding hurdles, the things that are going to get in the way of a move actually developing. And these are things that you need to think about in terms of it's a minimum expectation. It's the point that needs to be reached before you can even be confident that this trade is actually going to work in any way. The other way to approach a hurdle is to look at it as a decision point. For some trades, you're going to be able to say, right, I'm in the trade. Once we get to this point, I'm looking for a larger move, but this is the point where I can make a decision as to whether it's going to go or not. Sometimes you'll be in a situation where you're looking at a trade and thinking, right, when I get to this level, I want to see the market pop through and then I'll believe there's an additional move. But if you don't see that and it fails to do that, then you straight away can say, right, that's it for now. I can exit the trade. I can wait for more information. I can wait for an opportunity to come along later to grow as the day goes by. To take an example like this is one we looked at with a previous group. What we're looking at here then is a move in, this is the pound, bounce off lows, consolidation day with an attempt lower. So that's this little move down towards 20. So there's your situation. The next day, we open towards the lower side of this range. That's the range of the previous day. We open towards the lower end of the range, have an attempt down early on and bounce. So trader was looking at this, thinking to themselves, right, well, if I can get short, playing it through this kind of little pivot zone for around about 48, this kind of area, then we can look for a move down, break the low of the day, break yesterday's low, target 96, potentially further. What you need to decide, and you have to decide this before you take the trade, a bit like where's the target, what are you going to do here? Is this a case where you look at this trade and you say to yourself, right, 20 is my hurdle. If I get there, it needs to break. If it breaks, I'm staying in for the target at 96, or I'm going to wait, let it bounce. You have the possibility of rotation back, and then it's going to go. That's one approach. Or you say to yourself, right, that's a hurdle and a decision point. Either we're going to get there and bang, straight through. If you go straight through, the move is on, you can sit there and go, yep, this is it. We're going to 96. You can move your stop down, put your stop above the previous low. Potentially, if you want a little bit more safety, bring your stop down and put it up here at around 30 to give yourself that possibility that we bounce back before going, and let the move happen. Now, the way the market gets there is important. What you've got here is a market that chops its way down and then has one slam down, high volume, and doesn't keep going. That, to me, is crucial information. You've reached the hurdle. You've reached the point where this should go. And this is one of those questions of, what should the market do? If this has got the scope to keep going, it's going to jump this hurdle very easily and rush onwards towards 96, particularly with the volume that you've got there. But when it doesn't, that's telling you something. So immediately, you now need to be taking on this information. You get a few ticks below the level. Doesn't work, you get out as it comes back through the level. I think anybody looking at this, and the worst trade you could do here, of course you'll make more money, but the worst trade you could do here is get out there. Market drops through the low and you go, ooh, get out. I think that's one of those where that's a bad trade. Because if you get out there and it goes to 96, you have just given up a very decent chunk of that move. If you get out there and it doesn't, then it's easy to feel good about the trade and think, yeah, that worked well. But realistically, it didn't. You got yourself maybe 3 or 4 more ticks, but potentially at the expense of another 20 to 25. Whereas if you give it the chance that it doesn't go and you get out back up here, you've been proven wrong. You've been proven that this is not going to break the hurdle. This trade is no longer going to work. You step away from it and go, right, decision point reached, not made it. What information have I gained from this? How is this going to help me for the rest of the day? This is where, if you are very rigid on your trades, the trader in question here took the trade on and said, well, I sat through it and it came back and it stopped me out. Was that the right thing to do? Now, I don't think it's the wrong thing to do, but the information gained here is so vital that I think there was a very, very clear reason to want to be out of that trade way before it came all the way back to a stop. You also have to ask yourself, if you're taking a 35 tick stop here, how much more are you getting out of the trade? You're only getting 25 ticks more. So you need this to show you you're right. By the time it comes back and fails to break the level, you're now risking 35 of unrealized profit for the potential of 25 that doesn't look quite so likely anymore. Think back to probabilities on trade. When it breaks the level, probability of going to 96, high. Perhaps you're looking at 80%. When it comes back through and sits up here, probability of going to 96 in this moment, very soon, is going down and down and down and down. You're probably dropping below 50%. So the argument to stay in the trade really isn't there. You're taking 35 ticks loss. Of course, it won't be a full-on loss because you're onside, but with a 60-70% chance of having that loss. Not necessary, get yourself out of the trade. But as time goes by, you've learned something from this, more information becomes available. Now you have a second attempt. And this second attempt is better than the first. The first attempt was here, selling it here for this move, which doesn't work. We fail. But the important thing to remember then is, yes, this failed on a quick stab down and reverse. This is now the point where anybody looking at this low, this low, this low is now thinking, this goes back down there, I don't want to be long anymore. People are likely to get out, creating an acceleration to fill this kind of cave in. And that was the original trade down to 96. So now you have a situation where you can potentially play this from higher, because what's happened now is you've got a failure on a move up and the market coming back down. So as you come back down into previous range, you've now potentially got an earlier entry with good reason, with increasing volume after a failed high volume spike higher. Now you've got a chance for a shot. You've still got a hurdle along the way. You've got to get through this zone. But once that happens, now, rather than looking at this as a hurdle, this is becoming an acceleration point because of the information you've already accumulated. The expectation now is that if you get down towards 25, this is no longer, 20, this is no longer a chance or a decision point. This is now a point where you say, right, this is going to go. And even though it does bounce on the initial move, it doesn't come back up here. And because you've had the second attempt from here, you've got that safety. Gives yourself the ability to wait for it to go. Once you break here, that then completely opens the door. You get the rush down and you get that fill through the cave. So think about those hurdles, not just the first time, but if it was a hurdle the first time, what were people thinking when it first went there? What was the reaction? How does that then change the likely future reaction of a trade? It's all about looking forward and thinking about how stuff is now going to be impacted by what you've just seen, the way the market has just traded. Next thing we're going to look at is understanding your edge and what affects your edge. Now, there's two different ways that your edge can be affected from a game planning sense in terms of how you're trading. A lot of your edge comes from what you do in the moment. As a way of trying to describe this, there's two different approaches. One is if an idea is simple, your edge is in your access. What that means is that when there's an obvious trade, take an example like this, simple flag break. Particularly in higher volatility markets, these trades will play out more frequently. But when you have something like this, because everybody can see it and everybody knows what they're looking for and what they're going to do, this then puts you in a situation where your edge has to be in the way that you execute this trade, your access to the trade. So your ability to read a price ladder, to identify those little shifts and changes in the pace of the market, that's what gives you your edge. You've just got to be better than most other people. You don't have to be the best person here, but you have to be better than others in the way that you execute a trade. And if you can do that, then you will be able to get in here. But remember, there's a lot of competition. That's why your edge is so important there in the way you execute. There's competition. Everybody is trying to hit those last bids for the sell. There's not going to be many of those bids because people realize they're getting hit. So that's where you've got to be quick in identifying that little change and very quick and aggressive to act on this type of trade. Now that's for a simple trade. Dead simple. Drop, consolidate, sell, drop. Dead simple trade. Now, when the idea is beyond the crowd, the access is simple. Your edge is in the understanding of the idea. This is where structure plays a part. This is the type of trade for somebody who spends time developing a longer narrative of what's going on, of recognizing patterns over large periods of time. Take an example like this. This was a trade that one of our top traders looks at. It's an option expiry failed break trade. So this is a trade that is specific to a failed break on option expiry. It's not just any old failed break towards the upside. It needs to occur during the option expiry. For what? So that's one thing. That criteria differentiates this. So it's very specific. That's what takes this beyond the crowd. It's no longer just a simple pennant break and reverse. It's the timing. It's the very complex criteria that matter on this. So you get these stagnating ranges, falling volume, the option expiry forces the break, and then you get this bearish flag. Yes, there's an execution skill if you decide to execute on the flag. So if this flag is within this red box, then of course there's an execution skill to that. But you may well be in a position where you're already in. You've got in where you had no competition for entries, where you understood the trade and you could take your time to find an entry, to build your position up, knowing that as soon as you get that extra sort of technical situation that is simple to understand, that's going to be what drives your trade. And you're already in. You're ready for this to happen. You're putting yourself beyond the crowd, beyond the people who are waiting for that simple setup to play. Doesn't mean that this is bad. It means you have to understand the skill that you need to execute stuff like this. This is much more about your reading of order flow. This is much more about your understanding of wider structure and how that then plays out, generating new trades. Let's take an example. This is a trade in oil. This is one taken from 2019. If anybody wants the date, ask me and I'll be able to provide you the date so you can go and have a go at replaying and trading this trade. This is one that you would play from the open. Now, what happens here, as you can see, is open, little splash down, grind, 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 explosive liquidation move up. Now think about what's happening here. There's a lot of chopping here. Whilst the volumes are lower, there is a lot of volume done here because you've spent the best part of 2 hours just steadily drifting higher. So you've got all the time in the world to get in here. You can take your time, you can find an entry point, you can find an entry point where you can define your risk, perhaps below these previous highs. You can even look at an entry point down here. But by understanding the structure of the trade, what you're preventing yourself from having to do is get involved in the chase for liquidity, the explosive move that you get just here. We'll go and have a little look at this in a moment. And this all comes down to understanding the structure of a continued move higher, a range with an overnight sell-off. You get this overnight positioning, but this is not just overnight positioning. This is overnight positioning at the bottom of a range. So it allows you to play back up the range in a bullish market. That then also opens up the possibility then of a jump through the highs, taking out the top of the range and hitting stops. So the structure then means that if you're buying it down here, you quite possibly are looking for this move 100 ticks below because you understand that structure. You've seen these wider plays before. I mean, you've got all the time in the world. You've got options. You can enter down here. You can enter on the break of trend and the break of this little range. You can enter on some of the little pullbacks in here, perhaps above this zone. You've got time, you've got space to get in. Whereas if you're playing, looking at the move just to get in up here, then you're chasing. You're hunting down those last bits of liquidity and trying to hit those. Let me illustrate it and I'll get the ladder up to show you what's going on. Here we go. So if you've got up to the very top of this move and you're looking for the breakout, if you've managed to get in, great, but look at your opportunities to get in. This is where your edge is in execution. Your skill is to hit that last large order just there. If you miss that, the move, as you will see, will shoot off. Remember, everyone is now looking at this thinking, I want to get long before this goes. And so if you don't manage to get in, there you go, market jumps, it's off through the highs. If you're waiting for the break of the high to enter, chance of you getting filled on that, very, very low. A lot of that was stops that gave you that first move up. Now you've got to try and buy it higher if you're trying to add on to this trade or if you're trying to enter. Think about the competition you face for an entry. That's really crucial. There's nothing wrong with taking this trade on as long as you're recognizing there's little nuances in order flow that are going to allow you to get into the trade. They're going to execute that trade better. If you had no large orders there, no liquidity to hit into, you may well have been at a point where this trade would have gone by. While someone else could well have been sitting down here 100 ticks on side, but also with the ability, they can confidently hit into that. If it goes wrong for them and they hit that large order and it doesn't break and instantly fly up, that's okay. Because they've got this backing them up. They're already far enough on side that they can afford to be that little bit more aggressive than you. So it's not just about your edge being in your execution. It's also about your edge being in your willingness to be very aggressive from a standing start versus somebody who could well already be in that trade and much more free to take that risk. If this doesn't work for them, they're 100 ticks on side and it costs them 10 ticks, that's fine. Because they're just losing 10% of their trade. If it costs you 10 ticks, that's just an outright loss. And that's where gaining edge from structure can help you in, one, your execution, and also your ability to build a position up and be in with no competition to get into your trade. Now, that's not something out of the blue and a perfect example of it that is a one-off. Same trade, 2 years later. Same principle, trend up, range, overnight chest down, and trade towards top of range. As a minimum on a trade like this, you're looking to take out the overnight high. That's where you can then make a decision as to whether you stay in that trade. So this one, same principle. You've got your opportunity down here at the overnight low. You don't get so much opportunity to get in, and this is where tactics come in. It's not exactly the same in your entry, but you have had this test down and bounce. You can play the break of the bounce and play it up through there. So it's about going, right, I understand the structure of the trade. What is it that's going to allow me to take it on today? How are we going to take this trade on? This one's much more similar to the one that we looked at originally. Steady trend move down, fails lower, you can play out of the box in the trend, and then you get the liquidation up. That's the one that goes and actually breaks the high. So you could then potentially differentiate between the two different types of trade there. So the key to this is if you understand that trade in depth, it doesn't matter if you don't see it for a year, 2 years. That deep understanding of what happens means that next time it comes up, you're there. You already know what you're looking for, rather than waiting for everybody else who's trying to chase this bit of the move up. But recognize when your edge is different. Is your edge the same here? Arguably no. Specific criteria. This is differentiated. Yes, you have got that overnight positioning move. But should you be so confident of this rallying when this is not allowing you to get in at the bottom of the range? This is a trade where actually you're falling back into the range. If you can't get back out above 82.99, this move perhaps doesn't happen. So now your edge is going to change. This comes back to the sequence of the action. More, you want to be thinking about your tactics of, well, you don't want to be involved until you get up above here. That's back above 83. Up above there, yes, now you could consider something like this, but you don't want to be playing it in the same way that you might have played this and this, because the situation is different, and your edge in understanding the situation is to recognize that this is not the same and it's not to be played in the same way. Speaking of that whole idea of competition for entry, available liquidity, you need to be thinking about the viability of an opportunity. And this is all in the difference between what a chart looks like and what a ladder looks like. On a chart, you can see a nice big green candle, let's say. And you could quite easily look at that and go, right, brilliant. I'm gonna get in, boom, move's gonna happen, big winner. And in looking at that, it's very easy to say, well, I could get in there and I could get out there. Now, the problem of that is that you can't do that, and you have to be realistic about it. How much can you really take out of the move? So what you're looking at is not the size, but you're looking at the percentage of the move that you can genuinely extract. Now, as a reasonable rule, at least on a larger, more swing type trade, it's a reasonably fair thing to suggest that you're not going to get the bottom 10% of a move, nor the top 10%. Why? You don't know where they are. As the market falls, you only know where the bottom of the move is after it's turned around and gone up. So you're never going to get the bottom 10%, because the bottom 10% is the bit that tells you this is now a reversal. Equally, at the top, you don't know how high this is going before it turns back and illustrates that the move up has also ended. So you miss the top 10%. Understanding that then manages expectations for one. So you're only going to know these things after the move has happened. But you need to have at least an expectation, certainly if, let's say, you're buying the low down here, what you're looking to get out of the move. Because if you're missing the bottom 10% and you're going to miss the top 10%, that middle bit needs to be big enough to make it worth it. Now, when a move gets faster, that competition changes the percentages that you're going to get. As a move gets faster, it may well be that with such competition, you might miss the bottom 20, 25%. Now what you're doing is you're squeezing that middle of the trade. If you get to a point where you're missing 25% at the bottom and 25% at the top, you're now at a risk that this has got to be a big enough number move, in terms of number of ticks, to justify that trade. Now, the larger the move, what happens is that the smaller the percentage becomes that you can get in. Now, it doesn't sound sensible, but this is all about the number of ticks that it's going to cost you to get into a trade, the viability of your entry versus the size of the move. So, let's take, for example, let's assume that this move is 20 ticks. It's a fast market, so you're going to get a lot of rush and competition for entries. That could mean that quite reasonably, you're not going to get in for maybe the first 10 ticks. This is quite an extreme example. Very quick, you're not going to get in for the first 10 ticks. That means there's only 10 ticks left. Now, you're not going to get out at the top. So at very best, assuming you got very lucky, you might just match your risk. Because of course, you could buy it here and the market could turn back if there's an additional bit of information, if it's a misinterpretation of the news, if indeed this is just a very fast bid, very large order comes in here and slams the market back down. You could lose. So without an expectation of how far this is going to go, you could be in a situation where you risk 10, your price to get in, and then only manage to extract 10 at best. Even if it's 20 for the whole move, the result of this trade, assuming this is 30 for the whole move now, and you could potentially get 20, you're still going to give up at least 5 or so of those. So now you're looking at 10 for a possible 15. It's not bad, but you're effectively giving up 30% of your trade, 33%. Now, when the moves get larger, the percentage that you miss is likely to get smaller because of the fact that the moves become faster. It will not use as many ticks to get in. Let me explain. Let's assume this is 100 ticks. Now, because of the competition for entries and the fact that the higher this goes, the more liquidity there is likely to be resting, you're likely to be able to get in not that much more than 10 ticks off the low maybe. Maybe it costs you 15 to get in. But now your upside is so much greater. Even if you give away 10 at the top, you're missing 50 at the bottom, 10 at the top, you've still got 75 in the middle. So as a percentage of this, much, much bigger. This is 20% of that 75. So it's a 5-to-1 risk reward. You have to think about the viability of a move. If you're giving up a large amount for a very small move, is it worth it? Prime example when this comes down to scalping is if you're in a thick market, let's say something like Euro stocks, and you're looking for 5 ticks. If you don't get filled on the bid and on the offer, but instead you hit market, you forego 1 tick at the bottom. You hit market at the top, you forego 1 tick at the top. So now you've effectively made 3 ticks total on that trade. But your stop will increase to 2. You miss 2 at the top, you miss 2 at the bottom potentially. You're now putting yourself in a position where the viability of this trade is going down rapidly. You've given up 40% of that trade by hitting market rather than waiting to get the fill. And on a very thick market, that really matters. That makes a huge difference. Thinner markets with larger movement, more volatile markets, you can afford to hit market at the bottom because there's enough move that that extra tick you pay up doesn't make that much difference. So think about the viability of a trade. Think about the way you execute and how that influences what you're getting out of the trade as a percentage of what you potentially could. If you're looking for a 100 tick move, paying 1 more tick to get in and hitting market is worth it to make sure you're in. If you're looking for a 5 tick move, paying 1 more tick to get in is massively diminishing the value of that trade. You're dropping 25% of your trade just by hitting market. And if you do that at the top, you dropped another 20% of your trade. So think of it in terms of what percentage of your potential payout are you giving up in the way that you execute. It's vital. The bigger the move, the more leeway you have to enter, the more willingness or ability you have to be able to enter at market and not be influenced too much by that. So think about the competition for entry. It will widen the percentage, it will widen the zone. It doesn't necessarily increase the percentage to the same degree that it widens the zone. So think about the percentage of what you're risking to get in versus what you're actually likely to get out of the trade. Make sure that those are viable options. Of course, you can't know that precisely, but you've got a good sense of how far a move is going. If a move's only going 20 ticks, you don't want to be paying up 10. And if you can't get in within 5 ticks, it's not a move you want to be on. The nature of movement also impacts edge. This is about building up an idea of how a market is moving on a day. Over time, you'll get a better understanding of how a market is moving generally and then a better expectation of how it is moving anyway. So it's about thinking about, well, how is the market trading at certain points? If you have a market, for example, like this, where we're trading a block off the low and you start building up a lot of volume down here and you get very sticky movement, what this is showing you is that people are selling and they're struggling to keep the move going. This is going to change the nature of what you do. If you're looking at the reversal to the upside, if we're in here, what you can then expect is if people are selling and they're getting nothing for it, they're not even getting a chance to get out because it doesn't give them anything to the downside, you're going to have to play something like the green move, where your edge is going to be your execution here. The expectation is now you're going to get this scramble move as everybody exits above the range. As that happens, you've got to chase this. So you've got to recognize that shift to that kind of scrambling type action and get in quickly. So the nature of what happens here influences the way you enter here. Whereas if you have a situation where these sellers do get the move, but it doesn't continue, now this changes the way you're going to execute. The nature of the move has shifted. Now you have an opportunity to get inside the range. It gives you a better entry. Why? Because some people will have sold this and now are forced to get out, so they provide a bit of buying pressure. Others who are in the trade now are looking at this from a point of view that if it goes up here, they're going to have to get out. You don't need to compete for entry now. You've got time to enter here. Yes, it could go wrong, and the market trades up and does go down again, but the odds are leaning in your favour now. You know that there are people trapped here and here and here, so now you have the ability to play for that. Build your position up on the expectation they get forced out. If it goes wrong, you know what your risk is, whereas here, if you don't get that scramble and if you mistime that entry, you're then still risking down here. Think back to the cost of a bad entry. So there's different ways that the nature of movement is going to affect the nature of the way you execute on a trade. Crucial to be thinking about. Take, for example, one of these. And this is an example of a trade where you'll lose to find that out. Take a trade like this. Momentum picks up. Market starts to drop rather quickly down towards 72.02. So it's the bottom of where value is established on the day. So this is coming down on the T print. And bang, gets whipped straight off the low. You're likely to lose here, or at least give up some of the money that you've made on this move. When it gets pinged off the low, decent volume, and then starts to trade up, you're going to have to give that up. Same again. Sells off, little flag, stab, rips off the low again. These are really frustrating trades. If you make some money, but give a fair bit of that up, that's frustrating. If you try to play the break here, you're almost inevitably going to lose. Equally, that's quite a good slap in the face. Now, you need to take those losses, turn that over into information. What information are you gaining here? Clearly, this is a market that does not gain momentum as it hits lows. Instead, sellers aren't confident enough to keep this going. So the way you have to think about this is now, the nature of movement means that you are going to have to wait for pullback once the market has shown direction. So it's easy to say, well, you just sell the break here. But the viability of selling that break is not great. The recent action has proved to you that it keeps getting ripped back up. So either something needs to change significantly here to give you the proof that this is going to work. And the only thing that I think does happen is you get this snap down and then we accumulate volume lower. That's one way to do it. But you still see this chasing order flow. So instead, you want a pullback. Once we build volume and you get a pullback, yes, you've given up a chunk of the move, but you've seen the nature of this. You know how this is trading. Now you can take this trade on, and when it goes, you're happy with that. Fully aware that you could well have a similar thing to this, and if it starts to rip off the low, you don't want to hang around and get trapped in that ping up off the low. So think about the nature of what you're seeing so far and how that influences the way you're now going to execute on a trade. We talked about execution routine, so we don't need to go over it, but just a recap reminder of your execution routine. Make sure you're always thinking about access. If you can't define target, your risk isn't framed. If you can't define stop, your risk isn't framed. All you have is a possibility to enter. Know how you're going to enter it. What have you got to do? How is the nature of the way the market trading going to influence the way you enter a trade? Once you've questioned all of those things and you have a clear answer, you know what you're looking for, then the access is immediate. Execute. Once you've got that all defined, there's no reason to hesitate on your execution. Right, final thing to think about is opportunity planning. This can relate to news. It can also relate to the day as a whole. Now, what opportunity planning is about is opportunity value versus opportunity frequency. The green here is the frequency of opportunity. And this will be applicable on a news-based story, but also on day-to-day. Think of a market that is directional, then loses direction, but stays slightly volatile, and then completely loses direction. What you're getting here is low opportunities, then suddenly lots, because now let's say you've got a market that trades down and trades like this. You've got lots of opportunity in here, lots of things you could do, and then it just dies off. Opportunities diminish, value of opportunities go. What's important to remember here is that the first opportunity is the one of highest value, because this again is one where there is less competition for it. People are not aware of it necessarily. People wait to see something happen before they get onto a move. If you understand and recognize this, this is where the highest value is. Now, once the move's happened, you don't want to get caught up in the chasing it around looking for more. When there's more volatility because the market's been shaken up, which provides more opportunities but less value in the opportunity. It's crucial when you take a trade on and you think you should have got more to ask yourself, well, I'm not going to get any more now. Why am I now trying to hunt down more when the action has already happened? This applies in news as well. The first change in a situation, new piece of news, is the big one. That's game changing. After that, more news provides colour. It provides a bit more information. It builds the story up and potentially could lead to something else. But whilst that's happening, you're getting more and more pieces of the puzzle, which are not changing it, they're just adding clarity to what you already understand. That's what happens here. High frequency of information, of opportunities, but low value of opportunity. They don't translate into anything larger. Opportunities will then stagnate. If this is a news story, eventually the news dies off. The Ukraine-Russia war is a prime example of that. Action in February, March 2022, and then the story goes on. The information about it continues to come. The tradable opportunities diminish very quickly. You could argue the same with COVID as well. For a day-to-day perspective, market stagnates, then you could get a next move. And that's where, as you're getting less opportunities to do something, as the market stagnates, the next one changes. And it's that change, it's a very distinct change that creates the more valuable, clearer move. Markets will move through this as a way of kind of thinking about the value shift in a move. It will be like this, like an echo. Quite extreme moves early on in the initial action, same with any kind of news story. They will then diminish, and then you'll get a new piece of movement, a new extreme move, which moves you to a new area. Think of this as a kind of double distribution day. You may well get a couple of early moves of large size, followed by stagnating moves. You can still do stuff, but the value of those is going to get less, and then you get the break. That's where the next bigger value move is, before then a high frequency of lower value moves. So let's think about that in how you're executing trades. Where's the real value? Has the value gone? Are you now trading the flow of information, the chatter, the kind of grey area of a story, of a technical move, of what's going on? Or are you actually trading the changing piece of information? Ask yourself, where's the value for you? For some people, they can extract value from the high frequency of trade. They may be low value trades, but they can take lots. Other people, it's about taking that one high value trade and then reducing activity as the number of opportunities goes up. Think about that, how that affects you. Think about how that is going to play out into your day-to-day trading. I'll leave you there on game planning. See you later.